Silver is one of the most popular precious metals for investors, but it has a problem. It doesn't pay you anything to hold it. No dividends, no interest, just price appreciation or depreciation. But what if there was a way to generate income from silver exposure? That's exactly what SLVO is designed to do, and today we're breaking down how it works, what the risks are, and whether it makes sense for your portfolio. SLVO is the Credit Suisse X-Links Silver Shares Covered Call ETN. It uses an options strategy to generate monthly income from silver, but that income comes with some significant trade-offs you need to understand before investing. This is not a simple silver investment. Let's get into it. So what exactly is SLVO? At its core, SLVO uses a covered call strategy built around SLV, the iShares Silver Trust, which holds physical silver. The strategy takes a notional long position in SLV and then sells one-month call options against that position with a strike price set at approximately 106% of SLV's current price. When you sell a call option, you collect a premium upfront. That premium is what generates the income SLVO distributes to investors each month. In exchange for that income, you're giving up some of your upside potential. If silver prices surge past that 106% strike price, your gains get capped because the long position effectively gets called away. This is the classic covered call trade-off. You're sacrificing potential upside in exchange for current income. It works best in flat to moderately rising markets. It struggles when prices move sharply in either direction. Before we go further, if you're finding this breakdown helpful, take a second to hit that like button. It helps the channel more than you know. And if you're new here, subscribe for weekly ETF breakdowns just like this one. Now here's something critical you need to understand about SLVO. This is an ETN, not an ETF. That distinction matters enormously. An ETF actually holds assets. When you buy a silver ETF like SLV, the fund holds physical silver in a vault. Your shares represent a claim on that actual metal. An ETN is completely different. It's a debt instrument, essentially an unsecured note issued by a bank. The issuer promises to pay you returns based on an index, but they don't actually hold the underlying assets. You're not getting exposure to physical silver with SLVO. You're getting a promise from the issuer to pay you returns that track a silver-covered call index. This introduces counterparty credit risk. If the issuer runs into financial trouble, your investment could be at risk regardless of what silver prices are doing. Speaking of which, prior to May 31, 2024, the issuer and counterparty credit risk for this ETN was Credit Suisse AG. As you probably remember, Credit Suisse collapsed in 2023 and was acquired by UBS. That's a real-world example of why counterparty risk matters with ETNs. Always check who the current issuer is and assess their creditworthiness before investing in any ETN. Let's dig deeper into how the covered call mechanics actually work. Imagine SLV is trading at $25 per share. SLVO's strategy would sell call options with a strike price around $26.50, which is 106% of the current price. If silver stays flat or rises modestly, those options expire worthless, and the fund keeps the entire premium as income. If silver drops, you still experience the downside, but the premium you collected provides a small cushion. However, if silver rallies sharply past that $26.50 strike price, your gains are capped. You don't participate in the upside beyond that 106% level. This is why SLVO is not the right choice if you're bullish on silver and expect big moves higher. In a strong silver rally, you'd be significantly better off just owning SLV or physical silver directly. The covered call strategy systematically caps your upside in exchange for that monthly income. Quick pause here. If you're enjoying this deep dive, make sure you're subscribed so you don't miss future breakdowns. I cover ETFs and ETNs across every sector and strategy, always with this level of detail. Hit that subscribe button and the notification bell so you actually see when new videos drop. So, who is SLVO actually designed for? This product makes the most sense for investors who want some silver exposure, but prioritize income over capital appreciation. Maybe you have a neutral to slightly bullish outlook on silver, and you want to get paid while you wait. The monthly distributions are unusual for an ETN and can be attractive for income-focused investors. It could also appeal to investors who want to reduce volatility in their silver exposure. The premium income provides a small buffer against downside moves, and the capped upside means you won't experience the full swings that physical silver investors see. However, I want to be clear about who this is not for. If you're buying silver as a hedge against inflation or economic uncertainty, SLVO undermines that purpose. In a crisis scenario where silver spikes dramatically, your gains are capped. You're giving up exactly the kind of explosive upside that makes precious metals attractive as portfolio insurance. If you want real silver exposure for hedging purposes, buy physical silver or a straightforward ETF like SLV. SLVO is an income product, not a crisis hedge. Let's talk about the risks you're taking with this investment. First, there's the counterparty risk we already discussed. You're dependent on the issuer's ability to pay. Second, you have the opportunity cost of capped upside. In a strong silver bull market, you'll dramatically underperform physical silver. Third, silver itself is volatile. The premium income helps, but it won't protect you from a major silver price decline. In a prolonged bear market for silver, you'll lose money even with the income distributions. Fourth, covered call strategies can underperform in highly volatile environments. When prices whipsaw up and down, you tend to get the worst of both worlds, capturing the downside while missing the recovery rallies. Finally, there's tax complexity. ETN distributions can have different tax treatment than ETF dividends, so consult with a tax professional about how SLVO income would be taxed in your situation. Here's my take. SLVO is a niche product for a specific type of investor. If you understand covered call strategies, accept the counterparty risk of an ETN, and want monthly income from a silver exposure without expecting big price moves, it could serve a purpose in your portfolio. But for most investors, this adds complexity without clear benefits. If you want silver exposure, a straightforward product like SLV gives you direct access to physical silver without capping your upside or introducing counterparty risk. If you want income, there are simpler ways to generate it than option strategies on precious metals. The covered call approach makes more sense on assets that already pay dividends, where you're enhancing existing income. Using it on silver, a yield-less asset, means your entire return depends on option premiums and price appreciation that's capped at 6% per month. That's a narrow window for success. Do your own due diligence. Check the current issuer and their credit rating. Understand the tax implications. Look at historical performance in different market environments, and make sure you actually need what this product offers before adding it to your portfolio. That's going to wrap it up for today's breakdown of SLVO. If you found this video helpful, smash that like button and drop a comment letting me know what ETF or ETN you want me to cover next. Your engagement helps this channel grow and helps me understand what topics matter to you. If you haven't already, subscribe to the ETF Investor for more deep dives like this one. We're building a community of informed long-term investors, and I'd love to have you along for the journey. Thanks for watching, and I'll see you in the next one.